so we can. Great. And just want to introduce to you today the participants in the webinar. Of course, you have me on here, but John Potter is the principal in the Potter Law Firm. He's an attorney and also is an investment advisor representative with Strategic Planning Corporation, has been for a good number of years. I also am an investment advisor rep with Strategic Planning Corporation, and we are all about helping people deal with the issues that put stumbling blocks in the way of them reaching their dreams and their financial goals and state goals, so that they get money to the people that they love and want to get it, and then during their lifetimes are doing things in the way that will be the most successful for them. We don't want to do this stuff for you. We want to help you be confident that you know what you're doing and why. And so that's how we tend to operate with folks, to help you just achieve what you're trying to. So without further ado, let's jump into successful investing. Means realistic returns. We're going to talk about returns today. It's something that we all tend to struggle with. And that's telling the story of returns. And there are stories that are told about returns. For most people, returns are kind of an abstract number that can vary wildly. So the name of this presentation could be called Level Setting Returns. And, quite frankly, for every person, realistic returns are not the same. The return that I think would be realistic might be different for me than it would be for John or for any of you on this webinar. So there's a lot to unpack regarding returns, and it's often confusing and for us, and it can cloud our judgment about the types of things we invest in if we don't have a real good, clear-cut understanding of how returns work and where they come from. So we want to cut through some of that today. And also, you run into situations at parties or at family gatherings around holidays where there's banter about investments and the returns that we get on those things. And so how do we participate in that appropriately and helpfully? So all of us have felt like this guy, Michael Scott. This is a millennial slide, by the way. It's, I've seen some of these things, and sometimes they leave me a little bit kind of like, what just happened? I'm not sure, but it is pretty funny. But he's saying he hates being left out. And when people are standing around at a gathering and they're bragging about some investment they made and how much money they made on it, we can kind of sometimes feel a little left out. Because a lot of people will say, Mike and John, your investment strategy is just too plain vanilla. And there's nothing really exciting or interesting about it that I can go out and say, hey, I really blew the top off this thing and hit a grand slam or something like that. It's hard to compete when your brother-in-law is standing there talking about getting triple-digit returns every year, and you don't even understand what your returns are. So you don't get a chance to really contribute much to the conversation. We don't want you feeling like a wallflower sitting around in these circumstances. So that's what we want to do today, is kind of give you some confidence and understanding about returns so that you can participate. And by the way, if your brother-in-law is getting triple-digit returns, in the Q&A, if you'll put his phone number, I'd like to find out what he's doing here, because we don't do that. We don't get that kind of stuff. But no, just kidding. But yeah, the thing we want to talk about today is help you to truly understand returns. So how do we do this? First, we're going to talk about misconceptions about returns. And there are a lot of misconceptions that exist out there. It's not a new phenomenon. It's been going on forever. And there's always going to be a new misconception that crops up because of all the media that's promoting the latest and greatest unique investment that's available to you so that you can beat the market and what everybody else is doing. And the second thing we're going to talk about is what is a market rate of return? Knowing what a market is and what market returns are, it will help you properly set your expectations and other people's expectations too, so that you're set up for a lifetime of success in investing, and you're avoiding the traps that investors are put in front of. And those are market timing, security selection, trying to pick the right stocks to be in at the right time, and then chasing manager performance. Who's the hottest hand in terms of managing money right now, and we're trying to chase that. So return misconceptions is the first thing we'll talk about. Going back, way back, there's always been misconceptions about returns. As long as people knew anything about markets and investing and all that kind of stuff. There were questions about where do returns come from, what are they, and how do we get our fair share of them. So there was a study done back a few years ago, I guess maybe not that many years ago, maybe a year ago, something like that, where they found that during this time period of 2020 and 2021, when the market was really hot, people were saying that they assumed that they were getting 21 to 24% returns, and that they will continue to get that. We're in a new paradigm maybe, or something like that. And even many advisors felt that returns would probably continue in the 15% range annually. So let's start out by asking, what do you think is a good rate of return? So if you will, in the Q&A, if you'll click on that, if you haven't already, and open it up, and just type down there in the Q&A a number that you think is a reasonable or a good rate of return for investing. So y'all go ahead and do that. There we go. All right, I'm seeing numbers like 6, 10, 6 to 8, 10%, 10%. I love this one. I have no idea. Sis, 5%, 6 to 8, 6, 5 to 10. Great, all over the place. 8. So yeah, I guess we're going from anywhere from I have no idea. I like this one. Depends on the market and your risk of tolerance. Hey. I'm giving this presentation today, not you, Daryl. Yeah, stealing my thunder. But yeah, all over the place. And, we're a group that's investing here together. And so we, probably have a like-mindedness about this. And so, when you think about different investors out there in the vast world of investing and all the different investment strategies they have, there's no telling what it's like when we vary as much as that, from anywhere from 5 to 10 or 12% as what we think is a reasonable rate of return. And so if we're not getting a consensus on what's a good market rate of return, who really can, right? So with that being said, it's easy to see how people, including ourselves, can get seduced by these one-off stories about some great success and somebody hitting it big. So chasing great returns is something that people do because of that, and it's been the case throughout history at all levels. So if we look back a little bit here, we go back to, let me see here. I think I just jumped ahead, did I? No, that's where I was. Okay, here we go. So we jump back into the 1600s, and in the 1630s particularly, it was thought that roughly a 20-fold return was a good investment return and one you should expect to get. Now, when I say 20-fold, I'm not saying 20%, I'm saying 20 times. So like if you invested $1, it would turn into $20 overnight. Is that right? I don't know if that's right. Maybe it's $200 overnight. I'm not really good at math, and my wife tells me, don't say that stuff. You know what you're doing. I don't know how to add and multiply and all that kind of stuff. But anyway, so if you invest $1, it like goes up 20 times immediately. So I guess that's $20 overnight. So does anybody out there know what period of time we're talking about? I won't wait for you to answer. I'm just going to tell you. It was called the tulip mania. And not to bore you with too long of a story here, but you know that in Holland, they have tulips and all that kind of stuff. And most of Europe in 1630s, they were overvaluing the price of tulip bulbs. They hadn't even germinated. It's just the tulip bulbs. And people were buying and selling these things in the markets. And people were getting insanely wealthy doing these trades. So not only were people getting wealthy, but everyone who invested in this market expected to get 20 times what they invested when they got in. no matter when they got in, which is what they did. They got, in many cases, 20 times until they just didn't. And so if we move the timeline forward, we'll come back to this, to the 1980s. In the 80s, a good return in Japan was expected to be roughly 30%. And this would be a good market rate of return in their opinion. If you recall what was going on at that time, the big deal then was their real estate market was just going nuts. And because of that, it drove their stock market up, and they got into this Japanese real estate and stock market bubble. And it was a huge boom in their real estate market. I mean, they're a small country. They have limited space. It was expensive to build, and just the prices were going crazy. People made obscene amounts of money, and the average investor even made great money during this period. And 30% was not unreasonable. It was very much expected. Anything less, people thought they were missing out. So how about the United States in the 1990s? Our expected return was north of 25% back then. So if you recall, you probably remember the cause for this large return expectation. It was the tech bubble. There wasn't anything really that you couldn't invest in and make money. It was really hard to lose money back then during that hot market of the 1990s, particularly from 95 to 2000.
Mike, I'm looking at some of the names up here and thinking how wonderful as long-term investments some of these were.
Oh yeah, it's interesting. Check that out.
Netscape, yeah.
Right. Some of these companies, they were hot during this time, but things changed. Yeah, anything people touched seemed to just turn to gold. You had situations where secretaries in these .com businesses were thinking they would become billionaires because of the stock options they were getting. It was really interesting, and it did create a lot of generational wealth for people, and it caused anyone that was getting less than what they were hearing about to feel like they were missing the boat. So then in the 2000s, there was a little different feeling about returns. It went from getting 25+% returns to losing more than 3% a year for an entire decade. During this time, investors thought the market was something to be afraid of, to get out of. In fact, a lot of people saw negative returns in their U.S. holdings for the whole decade. Not necessarily everybody. I'll tell you about that maybe a little bit, but for the most part, people thought that it was just going to be negative, and that this was it. This just is the cap. It's not going to be any different. So not all time periods are great for returns. Some cause people to just bail out of the market completely. The dead decade, it had a lot going on during that time. You had the recovery, the starting from the tech bubble that occurred in the 1990s to 2000. Starting in March of that year, the market started to take its tumble. You had the 9/11 event in 2001. You had the slowest growth in the gross domestic product, or GDP, that we'd had in decades. Job market was horrible. Housing market collapsed later on in that decade of the 2000s. And we were in a prolonged recession. So during this time period, it looked like, it felt like for most investors that the market was just never going to recover. It was the dead decade. And they were pulling out money, trying to find alternative ways to build their successful futures. People thought it lasted long enough that they missed the start of our recent bull market. And now people expect something different after the bull market of the 2000. It actually started in 2009, right toward the end of the dead decade, into the 2010s and onward. So now for the past 5 years or so, people are saying, nah, it's not a dead decade. We think 80% or more is a good return. That would be acceptable, just a paltry 80%. So what's been so hot for everybody under the sun that they're being told to invest in? You got it. It's cryptocurrency. So most of us know people that have invested in that and have made out handsomely, very nicely. I know a number of people that did very well in that. There's been various levels of success in that, of course, because everybody didn't jump in real early, came in a little later. And because of that, there's some that got in late and things didn't work out quite exactly like they thought it would. But a lot of people during this time have thought that these high returns of like 80% should be something we can expect to have in the market. But should we? It's just gonna be all over the place. So if 80% is not indicative of a true and good market return or rate of return for the markets, then why do we know about these moments that we've just looked at? 80%, 20-fold, 30%, north of 25, all these different time frames. Why do we know about these moments? Why is it that when it comes to the market and these time periods and these returns are mentioned, people intuitively know what we're talking about? Well, it's because who got rich, right? Rode off into the sunset with a boatload of money. Maybe. I mean, during these periods, there were always the stories about the one-off exceptions of people that did make the big pot of money. And but is that still the case 500 years later, like after the tulip mania, or 30 years or 20 years or 10 or even 5 years down the road? Are we just remembering the good times and looking back fondly? No, it's because we look at these returns and we look back in the past. And, at the time, we didn't truly appreciate that it was too good to be true what was going on. Instead, we were chasing anecdotal stories about this investment opportunity or that one or what have you. And instead, we should have been trying to understand what we should truly expect from the market. So we remember these times in history for all the people that jumped in and missed it and were left holding the bag. They lost their life savings in many cases. They ruined their investment futures and ended up coming out worse for the wear, unfortunately. So it's easy to get swept up and be enamored with the prospects of a booming market. We spend a lot of time, when we're thinking about this stuff, daydreaming about how if we did this and our investment took off, how it would be so good for us and change our lives and the lives of our loved ones. And nobody really tends to, in the heat of the moment, to pause and think about, what about the downside? If we did think about the downside and the amount of destruction that could happen, it could be greatly reduced. But after that destruction, we tend to sit back and think about things like tulip mania and so forth. And so, like in the tulip
Mike,
mania,
do you think some of this is recency bias, and we forget about everything that happened before 2 days ago, and get swept up and we think, oh, now it's different.
That's right. It's different this time is really the big mantra, isn't it? We will tend to forget what happened the last time because things are so hot this time, and there's so much opportunity. And how could we fail? How could we miss? So, going back, like for instance, 500 years or so to the tulip mania, when the 20-fold returns fell off a cliff instantaneously. You can see it there. February 3rd, it peaked. And, just a couple of months earlier, people were still getting in and the market was still going up. And there were still people probably getting in here, after just 2 days. It took a pretty heavy dip back down to where it had been December. But, some people may have thought, it's just a little breather before it, returns to that upward climb. Particularly that one back here in November of the previous year of 1636. But even after just a little under a week, you can see that you've lost a ton. And then by May 1, just a few months down the road, it's just totally crashed back to where it was before all this insanity started. So people watched this run up for a couple of months in 1636 and into 1637, then jumped in to get a good market rate of return. By February, they'd already missed it. So it was a big situation. The downside in Japan in their housing bubble, you can see it here, after they had returns of over 30% for multiple years, people then started pouring their life savings into the Japanese markets to get their share of the good return. Except by 1990, they were the ones that were left holding the bag and lost the majority of what they had put in. They chased what seemed like a sure thing, and they got bit. And of course, you know, for another 15 years or so, that market, as you can see here in the Japanese market, just languished and just never recovered back to these points where they were before. And of course, we remember what happened in the US in the 90s. We saw growth like we'd never seen before, year after year. We assumed that a good rate of return was triple digits over a 5-year period. You know, we were getting plus 25% a year, 37%, things like that. And so once we saw that happening for 2, 3, 4, 5 years, we convinced ourselves that's what we should expect. So we poured money into the market. And then what happened was a loss of wealth for the majority of investors. You can see that decline of 80% there. And this is what started the dead decade, where people thought that a good rate of return would just be keeping pace with inflation. Not today's inflation, by the way, but inflation back then, which, you know, in the 3% range or something like that. Today, if we were getting the rate of inflation, we might think that was pretty good. So after 2022, looking at that. Now we look at the effects of an opposite market run. So during the 2000s, from 2000 to 2009, investors were just bleeding assets. And it just seemed like year after year for almost that full decade, investors were seeing negative returns. And it looked like we could have hit a ceiling, and market's just never going to go above this. And this is what we need to expect. So people started jumping out. I remember a fella telling me he jumped out. I think it was in 2014 that he got out in 2008 during this time frame, you know, just before that crash right here in 2008. And he got out after losing, I think, only 14%. And I said, well, so how are you doing now? He says, well, I'm still out of the market. This was 2014, people. So what happened? People jumped out of the market and they figured, okay, I'll wait until it's safe to get back in, but they missed out on over a 200% return. Even after your downturn that we had in 22. You still have had wonderful returns in this market since then, but you had to stay in it to get those returns. Coming to today, the cryptocurrency situation, you know, you had many years going back to 2013 when it was first introduced where it did nothing, and then it did a little bump up. And then, of course, June of 2020 to June of 21, the market just skyrocketed, huge run up. And people that were there seem to be set for life. And some of those people took their profits, and they are. Some stayed in. You can see what happened. As of February 8th of 2022, about 55% of Bitcoin investors were underwater. So that's going all the way back and to those that jumped in on that huge run up when everybody was just saying, this is it. This is where you become a multimillionaire. It's even worse now after February of 22, after a whole year of this. You see how it's just continued to drop into 2023. So we know all these markets, not because of their good rates of return. We remember them because they have caused lasting damage to many people. And we're still susceptible to being wooed by these return misconceptions that you can expect to have these kinds of returns and jump in and have them going forward, or know when to get out before they drop and that sort of thing. You know, it's just it's a sad thing when people get caught by that sort of stuff. And then, of course, if you had asked me back in the 90s what a good market rate of return was, I might have told you 300%, or really almost infinity. So let me tell you my story with this company called Edgate. Back in the mid 90s, I got involved with a company that developed this online site called Edgate. It was an educational website that brought together parents, teachers, and students so that in the school setting, you could really help maximize participation of all the players, and it's developed over the years into a company that sets the standard for curriculum in many schools throughout the country. But in 2000, after spending some time with some big heavy hitters like Bear Stearns and Dane Roush, they were going to take us public in March of 2021. Leading up to that, the company was really having some hard times. And so I invested a good amount of my money, and have clients that invested money in it. But I ended up investing all my retirement money in this company to keep it going so that they could pay salaries, keep the people working on the technology and so forth. It was part of the internet craze. We got to that point in March where we were ready to file with the SEC for an initial public offering, an IPO. And Bear Stearns said, hey, let's hold off a little bit. The market looks a little weird. Let's see what happens this month. So we went to April, and April was still weird. In May it was. And then in the summer, they don't want to take IPOs out. And so we got to the fall, and Bear Stearns says, we're done. This isn't going to work. The market's in full-fledged retreat, and we're in a crash. So we're not going to be able to do this. So we went out and looked for private money then. In the meantime, I'm using my American Express and got $60,000 a month we're putting on there to pay bills. And I took a second mortgage on my house, put that money into the company. We're just going crazy. And I'm not getting paid anything, being on the board of directors and so forth. And so we get to 2021, and we lined up some private money, $75 million with a company that's about 3 blocks off of the World Trade Center. And on September 11 of 2021, things changed in the world, and those folks pulled out on October 15th. We bankrupted the company in May of 2002. I finally started getting paid because the court had me run the bankruptcy. So we sold the company off. It's still in existence today. You can go out and find them. They are doing really well, but we made the mistake, and I made the mistake of thinking I was a genius and had found the pot of gold at the end of the rainbow, and I could throw everything into one stock and become a gazillionaire. And it just doesn't work like that. My expectations for returns driven by greed were just totally unreasonable. So that's what can happen. It sounded like a great story while it was going on, until it wasn't a great story while it was going on and ending. So when we're talking about market returns, it's good to remind ourselves there's a big difference between gambling and investing. It's much harder to understand that you're gambling when you're in the middle of it. I didn't see it. I felt like this was a sure deal. I knew it. I was part of the board. I was part of the development and the process. If anybody's going to know what's going on, it's the insiders. They ought to know. But gambling is getting into an investment fallacy where you're chasing hot markets like tulip mania, the Japanese housing bubble, the tech bubble, trying to be a manager of technology like me in the 90s, picking stocks, investing all your money in one stock or in cryptocurrency. So what will help us go from gambling to investing and understanding what market rates of return are? Well, what a coincidence. Let's talk about market rates of return and what they are. Let's take some time and make sure we understand what's real and appropriate in terms of market rates of return. And so to do that, first, we need to understand what is a market. And this quote goes great here, because without a foundation of understanding returns, it's incredibly easy to fall into the next return misconception. So I'll read it. It says, truth, or more precisely, an accurate understanding of reality, is the essential foundation for any good outcome. So to have a good outcome, we need to fully understand what we're doing, and the expectations we have need to be based on reality. So any ideas what I mean when I say a market? So if you will, jump in there in the Q&A and tell me what I mean when I say, what is a market? What's a market? Give me an example or a technical definition or something like that. I'll give you some time to respond there. By the way, I'm seeing some of your other responses. I can't tell on the returns that are reasonable. It looks like somebody put in that their return expectation that would be reasonable is either 19.525% or 19,525%. That's about what I was thinking on that Edgate deal. It's about 19,525%. Okay, so we have some responses coming in here. Markets, the financial system. Another person said an environment where buying and selling takes place. Yep. I don't know how to define it. I know it when I see it. I love it. I love it. And what people are willing to pay. That's what happens in a market. You find out what people are willing to pay for things. So technically a market is a place where parties can gather to facilitate the exchange of goods and services. So the parties, they're called the buyers and the sellers. Market might be physical, like a retail outlet or like a bazaar in the Middle East or whatever, where people can meet face to face. And, it's like going to Target and you got a customer service person and you got a buyer, a customer come in. So, they're working together to come to a conclusion on a transaction. Or you might have a virtual market, like an online market, Amazon or what have you. There's no direct physical or contact, I should say, between people, and the buyers and sellers do everything online. So in terms of,
I feel like we need we should have had a prize for Daryl.
I know that Daryl hit it on the nose, right? An environment where buying and selling takes place. Yep, exactly right. We'll have a prize for Daryl. I'll take him to lunch one day or something like that. We have our places. So when people think about investing in the market, we tend to think about our own domestic markets. So for instance, in the US, you'll see over here, you got the Dow Jones Industrial Average, S&P 500, NASDAQ 100. Those are domestic markets that we tend to think about as the market. In Hong Kong, they're going to think of the Hang Seng. In Nikkei in Japan, all these different ones. When we think about the market, for our purposes, we're talking about all of them. Our portfolios are globally diversified. So when you're talking about the market rate of return, we're talking about a blend of all these indexes. And these indexes are, all that is just a way to measure the movement of the companies that make up the market in these different countries and then obviously the world. So it's a basket of stocks or bonds, and so that you can kind of see in general how that market's changing in value from day to day. So that's the market. So now we know what a market is. Where do the returns come from? I'm going to play something, I hope, in just a minute here, a short summarization of the market. It's from a guy named Jack Bogle, who was the founder of Vanguard Funds. But he's going to tell you that returns come from two places, and really, in reality, only one. They're the outcome of, or stock returns, I should say, are the outcome of business realities, like companies earning money. And then they also have to do with market behavior, like the price that a buyer is willing to pay for those earnings to own that company. So he's going to tell you that over time, the business reality thing, the earnings, the dividends, they tend to dominate, when we're talking about 10 plus years. But during the shorter runs, market behavior can dominate, where there's things occurring. He's going to use a term I really like. You'll hear it, I'm sure. So that's the simple answer. And what we'll run with here, but let him explain it. Hopefully this will come through. If not, I'll summarize it again as to what he says. So here's the clip from C-SPAN. It's hard to hear. So let me see if it works here.
The mathematics of the market are eternal. Complex and mysterious as the stock market may seem, its returns are determined by the elementary internet interaction of just two simple elements, albeit two elements whose qualities are different as night from day. The first is investment return, determined by dividend yields and earnings growth. Investment return tends to be recurrent and steady. The second is speculative return, reflected simply in a change in the price earnings multiple, price that investors are going to pay for $1 of earnings. Speculative return is intermittent and spasmodic. Add them together, we have the market return. It's that simple, it really is. And over time, it is earnings and dividends, investment return, that determine all of the return that is achieved by the stock market. Consider the past 40 years. Dividend yields plus earnings growth over that period came to a total of 11.2%. The actual return of the stock market was an identical 11.2% per year. In the long run, as it turns out, earnings and dividends call the market tune. But speculative return can be the driving force over short term and even over extended periods.
Okay. So he's telling us something here that's really important. And quite frankly, what he's really saying is that the steady returns of the market come because of capitalism, because of the ability for just hundreds of thousands of millions of investors and billions of investors and consumers making decisions about things. And yes, that will sometimes drive a market up because of speculation, like in these bubbles we've talked about in the past. But over time, that tends to return to a mean based on the earnings of the companies and the dividends. So you can have all this kind of stuff going on, but quite frankly, it ends up being a lot of noise when you just look, like he mentioned, over the last 40 years, the investment return, which comes from dividends and from earnings of companies, has run at about 11.2% a year. And if you just look then at, with all of the ups and downs of these different market conditions that were generated by speculation and so forth, that when it all settles, the market returned 11.2%. So if you can isolate just those earnings and dividends thing, look at them and then say, okay, so then what did the prices actually do? It works out.
So Mike,
yeah.
Another way to look at it might be, you tell me if I'm thinking about this the right way. You know, with speculative returns, you're kind of gambling on what you think might happen in the future.
Right. So
there's a whole lot of what ifs, but over the long run, the investment returns are built on what actually did happen in the past leading up to the future. Reading up, not up to the future, but up to the present. And so that's where you're getting your numbers, and that's why, tell me if that seems like seems like that's reasonable to think. There's a big component of that is when you're taking the actual what did actually happen to determine the investment returns.
Right. It's interesting. We use a lot of research from people that have won Nobel Prizes in economics on this data that they've looked at for almost 100 years now, going back to 1926. And it's interesting. No one has won a Nobel Prize in economics for the return that they've gotten by speculating on something, by being in one of these markets. Because it can't be replicated. I mean, it happened, and it happened in the past, and who knows what's going to happen next on this. But we can see patterns in markets and in these global markets and in different kinds of assets within those markets that then can be utilized to understand that markets give a pretty steady return over time. It's just all the unknown and unpredictable things that we can't know in advance that will drive us to do things outside of just letting the market give us its return. And that's where we can mess up and have a lot of problems. Yeah. So all of that brings us back to our original question, is what is a good market return? And, we might have some guesses still yet at this point. But our portfolios, when we look at that, they're not plain. And so the answer to what is a good market return is it depends, okay? A good rate of return is not going to be based on consensus. Like we took a poll of you all and got different rates of return. We're not going to come to an average and say, okay, that's a good rate of return for everybody. There's too many factors that go into each individual investor's portfolio that they're building out to say that 6% or 7 or 10 or 3 is a good rate of return. So the first thing that we need to understand is an investor's risk tolerance. So how much exposure to equity markets are you comfortable taking, right? If you can withstand a lot of up and down or variability, volatility of an all equity aggressive portfolio over a lifetime, you'd consider a good rate of return to be close to double digits over your investing lifetime, right? You'd be willing to see the market go up and your account value go up, great, and that would be exciting. But then when it turned and went down, it wouldn't be too disconcerting for you that you'd want to make a change. You'd want to still ride those all equity positions, all stock portfolio for the most part. If you, however, were a little hesitant about that much range of returns, that particularly the downs, that's what bothers us. We love it when it goes up. It's the downside volatility that bothers us. So if you were a little hesitant about that, you might want to be more of a balanced approach to your investing. So maybe half of the money in equities and half in bonds might be a place to go. And so then you'd say that a good market rate of return might be maybe about half of what the 100% stock market return looks like. Maybe not quite that much, because you still have half the money in there and some bonds too, but somewhere around there. And then if you looked at that and said, no, that's still too nerve-wracking for me, I need to go lower in my equities than that, because I just don't want that much variability in my account value from month to month. So a good rate of return might be slightly less than that for an investing lifetime. So that's one issue, risk tolerance, but it's not the only issue that would determine for you what a good rate of return is. We also need to understand your time horizon. So the longer that you feel that you have to invest, the higher the value would be of what you would call a good rate of return in general. The funny thing about this, and John, I don't know if you thought about this, Philip was talking with me the other day, said that, quite frankly, among our clients, there's, the belief that, oh, I'm 70 years old. I can't really afford to take any risk because I'm not going to live that much longer. But the life expectancy for a 70, 75-year-old is 15, 20 years more. The older you get, the longer the life expectancy pushes out. But
the other thing, Mike, that I've done some thinking about, we've got clients with resources. They're planning on passing assets along.
Exactly.
The time horizon we're talking about is not the client's lifetime, but we're talking about the time the client is going to have it and the kids are going to have it.
Correct. Exactly. So it could be decades, that is the time horizon. And, the key thing is people don't want to run out of money. And so to avoid that, you want to do better than inflation and have enough there to be able to generate the income for your needs and your wants, and then to have money left over. So you need to examine your risk tolerance. It's got to fit within what you're comfortable with. Otherwise, it's going to blow up things eventually. And then how long you think that money is going to be around. But then we also want to understand the philosophy. If your philosophy is more of an active management philosophy, then the returns that you might expect could be all over the map, just like we saw in some of these active opportunities that people came up on with tulips and real estate and tech and crypto and all that kind of stuff. So it's hard to gauge speculative returns. So if you're actively managing, it's hard to gauge what you would say at any given time would be a good rate of return for you to be getting. So there's all kind of investment philosophies out there for active investing, and the numbers as to what would be a good rate of return would be vastly different depending on what that is at any given time and what the conditions are in the market. It's hard to say that this is what I'm going to anticipate getting for the long haul and actually get it. But, that's where you might fall susceptible to people like Bernie Madoff and some of the things that he promoted, and it's still going on. And it's by people that we don't know their name yet, but maybe one day they'll be in the news. Like, what was the guy with the FTX thing? I can't remember his name now. Had two last names. Anyway, in a passive investing or structured investing philosophy like we do, you can expect that returns would be true market rates of return. In other words, they're what the market gives, because that's how we're investing, is owning the market in the level of volatility for the time horizon you're anticipating. And that philosophy then is going to give you something that you can be more reasonably assured that you're going to see those particular rates of return. Now you can plan on how much you need to accumulate and what you need to do with your budget and so forth to make money last like you want it to. So to do that, let's look at some historical returns of the market. And we're going to go back about 65 years to 1950. Or actually, we're going to look at a period of time of about 65 years. Sorry, 1950 is a little further back. It's around 70 years back, 73 years back. And what we're going to look at is the ranges of stocks, bonds, and a blended total return in a 50-50 mix portfolio, and what have been the ranges of returns they've had, as well as their average annual total return. So we're going to look at what are called 20-year rolling periods on the right side and bring it back to 10-year rolling periods, 5-year and 1 year. So what that means is this. On the 1 year on the left side, where you see that green bar that's really tall, it runs from a negative 39% to a positive 47%. That's saying if we look at every year from 1950 to 2015, 1 year at a time, the worst case scenario was down 39% during that time frame. The best year was up 47%. And that's in an all stock portfolio where everything you have is in equities. So you had quite a range of volatility in that time frame, and that is going to happen in any given year. So when you're measuring and saying, what's my comfort level? If I had 100,000 in my account at the beginning of the year, at the end of the year, I'm down to $61,000, and am I going to be okay? Because I know I might get 47% next year on it, what have you. Over the whole time, if you look in this white block up at the top, stocks averaged 11.1% a year. So the growth of 100,000 over just 20 years, thinking in terms of 20-year rolling returns, was you grew from 100,000 to 817,000, or an 8-time multiple. In bonds, you can see a little less volatility from a worst case scenario, and looking at each year at a time on average. 8% loss to a 43% gain. You average 6, and 100,000 over 20 years grew to be 321,000, or a 3-time multiple. And then finally, if you took half of your money and put it in stocks and half in bonds and had this blended portfolio here, it's kind of balanced. Your worst case is down 15%, and your best is up 33% over that time frame in looking at each year. And so you can see that in any given year, that's kind of what you might expect that you could see. And there could possibly be outliers, but anyway. So then if we say, all right, let's don't look at 1 year, because my investing horizon is not 1 year. Let's look at 5 years. And hopefully your investing horizon is longer than that, but it might not be. It just depends on your circumstance. But if it's a 5-year rolling period, then the all stock portfolio, its worst year was down 3%. Its best year was up 28% on average over 5-year rolling periods. So that's a per year rate of return. The bonds, -2 to 23, not that much difference. And the balanced portfolio up actually a positive 1% is its worst year to a 21% return. If you roll it up again to 10 years, you can see that the bottom, the worst case scenarios keeps moving up a little bit. The best case scenario comes down. They're getting closer together. And then when you look at 20 years, what you see is that the equities, all equities, have your highest rate of return, but it's only 3 points a year better than a 50-50 mix, and about the same 5 and 7 on the downside. So as a positive return on your worst years, I shouldn't say on the downside, but on your worst years, 5 to 7. So the longer you can hold the portfolio, the tighter the returns become, and closer to what is a general market rate of return for the level of risk you're willing to take. And so it's a very interesting way to look at things, to say, maybe I should consider either a higher or a lower volatility measure when I'm putting together my portfolio to take advantage of what I know I'm comfortable with in terms of risk, time, and my philosophy, and work that through that way. So this allows you to have a little better expectation of what market returns should be for your personal circumstance. So the thing we want to do is get your share of the returns. If you know what to expect and you can stand firm against the temptations of chasing the triple-digit returns that are touted out there and being seduced by otherworldly return stories from your family and friends and that sort of thing, instead of being potentially a latecomer to the party, you can invest in a portfolio that you understand that has proper expectations. And instead of being left holding the bag, you can actually truly get your share of the returns by just being in the market and holding it at your what's comfortable for you in terms of your financial peace of mind with your investments. So you're going to battle with this every day. It's not something that's just like one and done and you never have to worry about this again. There's always going to be something that is coming at us to try and draw us away. It happened to me when I became an internet technology genius, and it happens to other advisors occasionally. It wasn't until I really confronted myself and understood, one, what are true market rates of return? They're not what I got from speculating when we were getting $150 million valuation on this company that I had put this money into, and then one other day it went to zero. It's not that. But when I understood how markets work and where returns come from, then I stopped gambling and really started investing. And it helped me get over that hump by coming to an understanding of, number one, my philosophy is just truly understanding that I can't predict the future. I can't find a manager who can predict the future. I only know one person that can predict the future, and or knows the future, I should say. And so my philosophy of investing, I aligned with my values, understand that I can't do that. So what do I want to do? I just want to have the market because that's where some great returns are. So we've spent a fair amount of time to come to a conclusion that's important to understand returns. It's going to help you set proper expectations, and it will also help you keep from getting sucked into chasing the latest hot, unrealistic gambling deal instead of just investing your money wisely. Give you peace of mind financially, and it will also give you the ability to then help others gain that same sort of peace of mind for themselves. And you don't want to be left out in the conversation. You want to understand how these things work, have the confidence and education that we're trying to provide through these webinars and seminars that we do, so that you can participate and avoid the pitfalls of getting sucked into what your brother-in-law might have. That's the latest, hottest thing.
Brother-in-law usually is thinking all about the returns and not about the gut check on the risk and the tolerance there. And that's not the world we want to be living in.
Exactly.
And living in the world where we can sleep at night.
Exactly. And we tend to, when we're the ones that are touting the deal, we're touting our wins, not our losses. And usually the losses are a lot worse than the wins ever were. But what we want to do is you're going to see this stuff coming down the pipeline at you. It's going to tempt you. We want to turn you into someone that is able to participate in this and be the belle of the ball when you're in these discussions. But all joking aside, we want you to have the confidence and the understanding around returns so that you can initiate some good information when you're talking with people. Getting 50% of your money is great, but the easiest way to sustain and continue a good rate of return is to understand what you're doing and where returns come from, and then you can really help family and friends. You want to reframe the conversation. You want to take it away from the speculation and the things that are just not repeatable, and you want to control that conversation about returns. So being confident in your financial path not being swayed by the flavor of the month, that's the way to do it. So with that, we're done with the formal part of our presentation. John, I think we wanted to tell folks that the key thing that we hope you'll get out of this is, number one, you can call us at any time. We're glad to talk about this stuff with you, because this is key to understanding and to being confident and able to stay the course when all around you is going crazy, when the storm's occurring like it was in 2022. And quite frankly, I'm really proud of a lot of you. In fact, probably everybody on this call has held in there and done the right thing, and you didn't get called away by the siren call of jumping out and getting into gold or silver or whatever, all that kind of stuff. So congratulations, you did a good job in 2022. And I don't know what the future is, but if we wanted to say what the first 2 weeks of this year looked like, looks like you might be getting rewarded for doing it, but I don't know, it could turn around and go down the hole again. So, but you're prepared to stay the course if it does that. And John and I wanted to, again, say anytime you want to call, we want you to, but we also want to encourage you, as you have family and friends that could use this same kind of stuff, invite them to these things, introduce them to us so that we can have a conversation that might help them to achieve the goals that they want and avoid some of these pitfalls.
And again, that goal there is, we want folks to, we've seen enough stories of folks that got out over their skis looking to try to strike it rich, and all of a sudden things turn south and they panic and they lose a ton of money. We want the folks, to get a chance to really look at what kind of risks they're willing to stomach and set things up in a way that they're comfortable with, where they're not going to get caught where they're in a panic and they're taking their life savings and selling it for a loss.
Yeah, exactly. So I don't see any questions in the Q&A. If you have any, stick them in there right quick. But if you need to jump, please feel free. We won't hear a ding or anything when you leave. But you're happy to stay on if there are any questions. If you don't want to ask them on the Q&A here where we answer them, feel free to shoot us an email afterwards, and we'll be glad to respond to that and help you out with anything. But and
remember, tulips are a great talking point at parties.
Yes,
tulip bulbs.
Yeah, bring up tulip bulbs and explain how that works for investing returns.
It's good for people talking about investments or gardeners. So
either way, you'll hit a broad spectrum there. All right, I'm not seeing any further questions. We will adjourn for today. We will be having another event in mid-March. You'll be getting information about that, and we look forward to seeing you there. It is going to be an in-person event. So enjoy your winter, stay warm, and we'll talk to you soon. Thanks for joining us today. Bye for now.